Austin. It's been quite the week. Do you want to introduce yourself real quickly?
Yeah, absolutely. So I'm Austin Grandinetti. I'm one of our wealth advisors and certified financial planners here at Annex Wealth Management. My job is to sit down with the individuals and families that we work with and figure out how we can best serve them and identify the key opportunities to improving their financial journey and help set them up with the right wealth manager to do so.
That's awesome. Yeah, it's been great having you on the team, and I'm so glad that you're here because you're hearing directly from clients and prospects about what's on their mind. And so do you have any questions, or what are some of the things that have been popping up?
Yeah, absolutely. This week has been an interesting one. It seems like it's been a whirlwind of headlines. Tech has felt a little bit of a train wreck this past week. What's been kind of behind some of those moves?
Yeah, it's really interesting how well technology stocks have done over the last 3 years and even year to date, but they have encountered some volatility. I think one of the things that's really been weighing on tech stocks is the valuations. Now, the way that we look at things on the investment committee is that valuations, so like market multiples, price to earnings, price to sales, whatever your favorite metric is, these are more of a reflection of what's going on, not a cause of what's going to happen. And so we like to decompose it as far as, okay, well, what's going into that? And if you think about the way in which the market is valuing a lot of firms, it's about what are their present operations and future growth prospects. It's kind of like basic finance if you think about how to value something. And it just seems like lately there have been a few more questions being raised about those future growth prospects. A lot of the companies in the tech space, especially where we've seen some of the volatility, it's been more about, hey, you know what? They had 35% year over year growth, and now they're projecting it's going to be only 31%, right? That's still incredibly fast, but it is the importance of those high expectations raises a bar. It's kind of like if you're an A+ student, if you suddenly get a question wrong, you probably feel like garbage.
Yeah, exactly. So, and with that, we are getting to the tail end of earnings season. So is it starting to look like it's going to be unseasonably warm or cold?
Yeah, it's been unseasonably warm overall. When coming into this season, expectation was for about 7% year over year earnings growth. Now the run rate is something closer to like 10 or 12%. Oh. And it's somewhat timely that we're talking about this. I heard that the Farmer's Almanac, that they're going to stop publication.
After 208 years.
I know.
And all social media, too.
Yeah,
really?
Can you believe that?
Yeah. What are we going to do?
I don't know. But if you think about what they did, right, it's always about that longer-term outlook, sort of what can you expect. They had their models that were built on like sunspots, location of planets and all that. And it's just, people apparently aren't valuing it like they used to. But when we think about the earnings, the importance of earnings coming in, it's exceeding those expectations. That's kind of a good formula for having a positive strike reaction or positive stock reaction. And that's one of the things that we've been really paying close attention to is that when companies have come in, what were the expectations? Did they clear that bar or not? And then how does the stock price react? And interestingly, it seems like there's a little bit more sensitivity to the misses to the downside than to the beats to the upside. So I think it's just showing that, after a couple of years of really good returns, investors are thinking that, I'm going to take a little off the table here.
Yeah, that makes perfect sense. And I think you could make a narrative to support a bull case or a bear case in either sense. There's so much data out there. And one of the things that we're kind of looking at now too is jobs, right? There's been a lot of talk about layoffs coming up here between Amazon, Target, Meta. Each has announced tens of thousands of layoffs. Are things getting better or worse right now?
Yeah, we are getting mixed messages on there, and who knows what the truth is. What we are seeing with the headlines, if Amazon, if they're going to be cutting 14,000 jobs, it sounds like a big number because it is, and our hearts go out to the people who are affected by that.
Sure.
But if you think about the overall economy, in any given month, there's roughly 5.1 million jobs that are filled and roughly 5 million that, as far as separations, whether people quit, if they're fired, laid off or whatever, right? That's a massive number. So if you think about 5 million and if you have 14,000 here, 10,000 there, they get big headlines, but it doesn't have a big effect on the economy. So when some of the data that we got this past week, there was private sector payrolls from ADP, Advanced Data Processing, for the month of October, plus 14,000 or plus 42,000. So that's finally positive after 2 months of decline. So maybe it's making a turn. We have heard from a firm called Challenger, Gray & Christmas, layoff announcements. Those have increased, but these are announcements about what has happened or what's planned. And those aren't very good indicators about what's actually going on Main Street. So even though there is this increase in the number of layoffs announced, it's not seeming as though it's becoming a reality with initial jobless claims or things like that. So I'm thinking that actually the job market is beginning to get a little bit more traction here after a rather rough end of spring and summer.
Yeah. I think one of the other big headlines I've been hearing from the individuals and families we serve is that, we're 37 days into the longest government shutdown in U.S. history. What's been the impact of that? And is there really an end in sight?
I really hope that there is an end in sight because I would like to get some of that data. Again, we didn't get the employment situation report again, right? So what am I supposed to do? It's like walking around in a fog. And that's actually, I think, one of the market reactions is the Fed has talked about how reliant they are on some of this data. How can they set policy? And there's a difference of opinion. Should they just continue the course they're on? Should they take a pause? We'll have to see. But in terms of the economic effects, there's all sorts of different ways to measure it. One of the things is obviously the individuals affected. They're not spending the money. They're having to maybe live paycheck to paycheck, and now they don't have a paycheck.
Right.
So what do they do? Right. So if for their microeconomy, for those individuals, it has a much bigger effect than it does on the broader macroeconomy for the U.S. as a whole. But it does seem as though it compounds as time goes on, where it's like, okay, kind of a small effect at first, and then it grows and grows and grows. We're seeing it with flight delays and cancellations. Businesses are feeling it as far as a lack of regulatory approval for different projects. So it is having an effect, and it seems to be that it is beginning to snowball.